Welcome to the Tax Assist July webinar on boosting profits and cutting taxes. Practical tax strategies, as the slide says, for Irish SMEs. So really a focus on growing companies and possibly even sole traders looking to move into companies based on various reasons, which we'll touch on later on. Seminar today will be about 20 to 25 minutes. There's a Q&A function at the bottom of your screen. I won't take questions during it, but if you type in during it, we'll reply to them after, and also even after the presentation. If you think of anything, then just put in the box and we'll deal with it. If there's anything a bit more complex, I might just take it offline and I'll get your details and I'll give you a shout back. So I suppose just to introduce myself, my name is Garrod Condon. I'm formerly CPA, now an FCA accountant, chartered accountant, working in practice for over 25 years. Did a stint in industry as well, so this is very relevant from my background. Working with a lot of Irish SMEs, basically in terms of growing their businesses, reducing tax a lot of the time, and looking at grants and funding, etc., just to aid cash flow. So just to start away, just go through a number of points, really. It's about 10 points to work on. Some will be familiar, some possibly not. So just the main one to start with really is just about general business costs, okay? So how corporation tax works is, you know, your sales or gross profit, less your expenses, and basically taxable profit. Might be capital allowances involved, which I'll come to later, but you're basically taxed at 12.5% from a trading point of view. Investment income in the company or rental, we'll touch on later, which will be 25% plus additional tax, but 12.5% for a trade. You're taxed only on the profits after your costs. Obvious business costs there on staff salaries, rent, marketing expenses, etc., advertising, whatever you want to think of. Must be wholly and exclusively for business use, which you might be familiar with as a revenue term. So in terms of your preparing your P&L, of course, you can put in expenses relevant to your business that you feel are relevant, but from a tax point of view and a revenue point of view, they have to be wholly and exclusively relevant to the business, okay? So the obvious one there is borderline personal use and things like that. There is a situation where you could do a portion, possibly in terms of, you know, own ESB or something that's used personally, but also clearly used for the business as well, and you might have to do an add back on that. But in general, things to watch out for, as you might see yourselves day to day, is especially travel, things like that. Travel and entertainment are probably two areas they focus on, motor and all that, which is tied in out to your monthly payroll returns anyway. Big thing there is just around, you know, keeping tidy records, receipts, invoices from the accountant's point of view, but from revenue's point of view as well. Okay, if you ever got a revenue audit, it's pointless having to go back then 4 or 5 years looking for stuff. You know, you should keep on top of it as you go. And one of the points we'll come to as well as we go through this is a lot of tax planning with companies. You need to do it at the time. So for example, it's July now. If you're tax planning now for 2025, 2024 is gone as far as tax planning is gone, really. Okay, slightly different than a sole trader point of view, when you could do pension top-ups, etc., after year end, reduce your tax bill. From a company point of view, for example, pensions, you have to do that during the actual calendar year, or during the accounts year. Okay, so you plan during the year, which comes back to my point about up-to-date, tidy records. You really should have a system where you have a good idea of your monthly P&L, okay, or at least quarterly. Okay, if you look at a lot of companies are December year end, you know, waiting till August to start getting your figures in September. Like if you're a December 24 year end, for example, if you haven't got your figures yet, it's September 25 before you have your P&L and your tax. Too late for tax planning, but also you're 3/4 of the way through 2025. So have you missed out in 2025 as well? Okay, so, you know, tidy records, accurate, up to date. Okay, and just at all times, personal costs are non-deductible. You know, and you see things there in Element, which we'll touch on later on BIK. Okay, so when to use BIK and when not to use it in terms of taking benefits from the business. Okay. So just in terms of staff perks, which is a very popular one, just touching a few points here. So there's the small benefit exemption, changed in the last couple of years. So it came in a few years ago, which was brilliant. It was very tight at the start in terms around the rules, but loosened up a bit and loosened in terms of it's, I suppose, more flexible. So in terms of at the moment, the big ones is the 1,500. So gone from 1,000 up to 1,500 per employee, tax free. And the other one's the number of gifts per year. So that's gone to 5 now as well. So just to be clear on that, if you say, for example, we're giving them €250 every 2 months or something, and you're going to give them 6 gifts to get to the 1,500, your 6th one will be taxable. So even though you're below the 1,500, you've used up your 5 gifts. Okay. From a practical point of view as well, just a few things around that is Don't have to keep it for Christmas. Has to be done to claim it in your accounts year. Has to be done in your accounts year, and by right you should pay it out. We've seen situations where people have accrued for it, but like from a revenue point of view, they'll say it should be paid out in that year as well. So get the gift, pay it out. A lot done around Christmas, which from a from a business point of view, you don't have to do. Maybe think about is it especially if you're intending to give them X amount, €1,000 voucher, would it be better out spread out 500 and 500 during the year as good incentive, summer holidays, kids back to school, this kind of stuff. You can spread it out. Um, the one thing to watch there as well is just to be aware that if you're on the payroll yourself as a director, you're entitled to that, as are any of your family members if they're on the payroll as well, up to the 1,500. I'll touch around that later around the whole thing about spouses and children, etc. on payroll. But if they are legitimately on the payroll, you can use the 1,500 as well. Okay, so that's a very good scheme. No POE, PRSI, USC for the individual, and also no employer's PRSI, which is a big thing as well. So, the employee's benefiting and you're benefiting. And the other thing is tax deductible, fully tax deductible for CT. So if you gift a 1,000, you're still talking about it's only cost you, what's it, 875. You're getting your 12.5% relief on that as well. Okay. And just remember that the 5 gifts per year is a big thing running through those. Also, in terms of giving it, it can't be for reimbursement. So they can't buy something themselves. For example, bought flights or bought gym membership or something and you reimburse them. It has to be a gift card or a voucher. So just be careful of that. In terms of employing family, I suppose being smart and compliant on it, and this is an area, like if you ever get a revenue audit, as I said to you there about motor and travel, BIK, one area they'll focus on. If they see family members on the payroll, that's another area straight away. So there's a few things and just to be clear, like of course you can employ them, If you're looking at children, just be conscious of, there's the revenue rules, which is fair enough, but there's also the social welfare side of it in terms of, well, you have minimum wage on it, but in terms of work hours. So be very careful and times of the year. Like, if you're bringing children at 14 years of age on the payroll, which depending on the type of job you could, just watching what are they doing, what hours are they doing, when are they working? Because there's only so many hours they're allowed to work during the school term anyway, so many hours per day. And it's about being documented as well. So a good guideline is, from your own point of view, is if this person, for example, you're employing your daughter, if she wasn't your daughter, what would you be doing with that role? So first of all, would you have that role? What would be paying that person? What would you put in place in terms of like, does that person have to do timesheets? Have they a contract signed? And the money transferred every month, etc. And is the role needed? And also does the pay rate reflect the role and the hours worked? So that's the big thing there, the fair pay for an actual work done. If you can justify that, of course, they're fully deductible. Okay, deductible. So an obvious one around this is around children where they don't use up their tax credits. Okay, and if you don't use their tax credits in the year, they're gone. You can't carry them forward or anything, or even their tax bans as well. So a question that comes up a lot is, oh, they're working the local super value or restaurant or something. Sure, I can't employ them. But the chances are like they're not going to use up their tax credits in their employment, and they can work multiple employments. And if you look at it as well, so the chances are you're giving them money as well in terms of pocket money or something, or paying for something, and they're probably doing work as well for you. So it's a tax efficient way of getting tax relief on money that you're possibly giving the children anyway. It's done a tax efficient way in terms of you could take, for example, €1,000 out of the business, it's gone to the children, no taxes paid on that in terms of they have tax bans and tax credits to cover it. There might be a bit of USC or something on it, a small bit of PRSI, but you're claiming it as a taxable expense on the other side at 12.5% anyway. Okay. One common use for it would be for saving for college fund or saving down the line, where you want to put money, instead of you taking money out of the business and paying tax on it and putting it into a savings account, you're paying the child who's putting it to their own savings account. A few things to note around that is that the money actually has to be paid over. It has to go to account in their name, so you can't say it's for them and transfer to your own account. Okay. And in general, the rules are the system you have in place with your spouse or your children for payroll should be identical to the system you would have in place for a non-family member. And be very careful of that, especially if you have non-family members, you get an audit, revenue see you're doing something, everything's so good for say we call them the non-family employees. Yeah, when it comes to the family ones, there's nothing there, no contracts, sorry, no timesheets, nothing like that. Paid more than anyone else, etc. like that. So And the best thing is, like, you have to have it documented. Okay, so document, I would say, is the role justifiable? Can they do it? And justify it by having the paperwork in place and treat them like a third party in terms of that. But the flip side of that is, once you're willing to do that, it's a great scheme. The other side of it is, just before we move on, is pension contributions. Okay, so even with children or spouses. So I suppose one thing to point out with the spouses, yeah, for example, if you put them through for 20,000 in salary, they can get a pension from the company of top up, if you want, of up to 20,000 as well, based on the current rules. So if there's cash flow there, it's one way of efficiently taking money out of the company. The one negative to watch as well with the children is just in terms of the current PAYE rules, sorry, PRSI rules are based on when you enter the system. So just be conscious of, if children are coming to the system at 14, 15, they could be starting their PRSI record then. And we would see it there at the moment with a lot of people approaching 65, 66, when they get their PRSI record, there's gaps. So they might have done restaurant work when they were 17 or 18 and then not worked for years, and they're being penalised for things like that. So get advice on it. It's not as simple as just throwing them on the payroll. So I'd be kind of conscious of that, and that'd be my advice to you. Just as we talked on directors' pensions, so tax efficient wealth building. The big thing to watch about it is the restrictions. So it changes there in the budget last year. In general, the easiest guideline is that the company can pay in up to 100% of the director's salary into a pension. So if the director is getting 100,000, or I'd say 50,000, sorry, the company can pay up to 50,000 in a pension. If they pay above that, which they can do as well, you use your CT deduction, and there'll also be elements of VIK and things like that. So in other words, you won't be doing it. Just more efficient ways of getting money across. So it's a good way of building wealth tax efficiently. And that said, you can bring the children and spouse, if they're on the payroll as well, into that system as well. Okay. It's tax-free. You don't tax free yourself. It grows tax-free inside the pension fund. And also you need to get advice around retirement planning and pension planning as well. Very good. If you're thinking about retiring, you're closing the company, retiring, liquidating it, there are various ways you can build up the amount of money you can get tax free out of the company. So you should get advice on that. And I would say 10 years, optimum is 10 years, but definitely 3 to 5 years before retirement, you should be seeing someone about your plan for your company, winding it up or even selling it, and how you can maximize the tax free element out of the company between pensions and reliefs. Again, it's just must be done correctly, obviously. Get financial planning advice on that. And it's a long-term plan as well. Okay, so I'm saying maximizing there 100%, but like there's ways and means of just taking out, especially if you're on lower salary and cash flow is tight, a smaller pension just to get it started. Separate to the tax advice in terms of tax savings and tax planning, CT, a pension is a good idea. It's like it's a form of retirement planning and long-term planning. So it should be looked at regardless of your situation. In terms of losses, so some people wouldn't be familiar with this, but there's difference between corporation tax and income tax in terms of losses. Is corporation tax losses, you can actually carry them back 12 months. Okay, so for example, I'm just saying there, if you had lost in 2024 and you had a profit in 23 and you paid corporation tax, you can actually request for revenue to go back and offset that loss and get the money back. So obviously get the money back or carry it forward against for preliminary tax or something, but you're entitled to that. You would have to do it through your accountant, done through my inquiries, but in terms of calculating it, get professional advice. You'd also have to weigh it up against do you have future profits anyway, and you're just going to hold them, but especially if it's something where you're erratic business performance, where losses some years, profits the other, cash flow is tight, then you should definitely look at that. So same with capital allowances, like you can use capital allowances to create a loss, and whatever the balance is, then balance of a loss, you take them back 12 months. Okay. Yeah, it can be very good, especially in terms of people as well who might have had one crazy year of profits and then suddenly lost the next year or something. Get your accounts done, get your loss calculated early, and go back and get your refund. And the only rules in terms of calculating around it is that it has to be the same length of period. So if it's a 12-month set of accounts, you can go back to a previous 12 months. If it was 6 months of accounts, for example, if you're changing year ends, you could only take that loss back for 6 months of the previous profits. But that's a very good one that a lot of people wouldn't be aware of. In terms of capital allowances, so I suppose the point to make with capital allowances when we start going through it, and you become conscious of people chasing tax savings and grants, etc. Do you need it, first of all? So that'll always be the first question. Do you actually need to do it? Do you need equipment, vehicles, the buildings? And then it's when you decide, yeah, actually we do need it, it's doing it in a tax efficient manner. So in terms of equipment, vehicles, buildings, you're probably familiar with a lot of those, but 12.5% a year straight line on vehicles and equipment. Just in terms of industrial buildings, by 15%. In terms of getting money back quicker, the energy efficient equipment is a big one at the moment. So that's 100% tax relief. So basically, if you buy the equipment now, you can write it off in 1 year. So it is an asset, but you can write it all off in 1 year. Just some rules around that. So it has to be new equipment and it has to be on the SEAI register, but there's so much on it. Obvious ones now will be around like solar panels. And if you look at vehicles, electric vehicles would be another one. Electric vehicles are worth looking at from a tax point of view because of the energy, it's energy efficient equipment. So I guess the accelerated capital allowances, but also from a BIK, so the favorable BIK rules. So the negatives of those is, first of all, that's like my earlier point. Do you want like an electric car? So you come in talking to your accountant about saying getting a new vehicle for work, and then you hear these tax savings and you say, well, sure, we get an electric one, but is it suitable just in terms of battery life and cost? Because they are very expensive and it has to be a new one to qualify for this. Okay. If you're looking at getting cash out of a business and you have cash building up in a business that you don't need in the business, you could look at an option of a company car through an electric vehicle. So for example, you'll have reduced BIK, you'll have your capital allowances written off in 1 year. But again, does that vehicle actually suit your lifestyle and your needs? So you just need to be careful about that. R&D tax credits. So I think a lot of people don't even realize that they might be eligible for this in terms of innovation. You definitely need to get professional tax advice on that because it's very detailed in one sense in what you can claim, but there is a lot of stuff you can claim. So basically the way it works is that if you're spending money on research and development, and it can be on processes and systems and possibly on equipment depending on what it's relative to, but in terms of you can claim it as a corporation tax deduction as normal for your 12.5%, but you can also get a 30% tax credit, which has increased since the 1st 24 now on top of that. So the rules around it, really, that it falls under their description, which is worth getting a professional to go through with you. But in terms of once you put the report together and you claim it, if you get it back, 30% tax credit, which you can get depending on the amount you claim, but you can get most of it back straight away, and you can actually get refunded, which is a big thing. So it doesn't have to just go against tax. You could set off against existing other tax bans, tax heads, but you can also set it off against corporation tax, premium tax, or actually get the cash back. And that's a huge thing. Okay. There is a huge issue around the how hard it is to apply for it, and it's probably been in the news lately, and having detailed records of it. But it's worth even having a think about, because you'd be surprised what comes in under R&D depending on your type of business and things like that. The deadline with it is slightly different. So it's based on your corporation tax year end. So if it's December 24, but you have 12 months, and it's a strict 12 months. So even though you might do your corporation tax return this September, say in 25, you actually have up to 31st December to do your R&D application. It is strict in terms of if you apply on the 1st of January next year, you won't get it for 24. It's just gone. Okay. And there's a lot of work to it, but like it could be a serious saving, because even if you had 20,000 of that qualified for R&D, that's 6,000 cash that you get back, and you'll still have your corporation tax saving as it is. Okay, so definitely worth thinking about. Sure scheme might be too late for some people, or if you're just recently into a company, usually around 18 months max, or if you're thinking about going into it. Okay, so basically the sure scheme is basically for someone with PAYE background, work PAYE, you've income tax paid, built up, and you're looking at starting your own business. Okay, so there are restrictions on it. There's restrictions in terms of the type of business. So an obvious one is professional services. So say as a solicitors, engineers, accountants, you can't claim it, but there is a long list of businesses that you can claim it for. So you set up your company, and then the other restriction on it is that it has to be invested in share capital. So for example, if you were due a refund based on the scheme of just say 20,000, that 20,000, it doesn't come back to you in a check or into you personally. That has to go in the share capital in the company, and it has to sit there for a minimum of 4 years. Okay. The flip side of that, so that's your kind of handcuff is there in terms of you tied into it for a minimum of 4 years. But the flip side of that is it's money coming back. So that 20,000 comes back and it goes into the company current account and can be used to invest. One of the conditions of it is you have to create at least one full-time job. That can be yourself. Okay, so as you're going to work in the company as a director, full-time director, there's limits on what you can work elsewhere. I think it's around 10 hours a month, but if you're not working elsewhere at all, it's fine. Just go in, you pay yourself a salary and you qualify for the scheme. So that's definitely worth looking at. Okay, so the big ones are the type of industry, the money has to stay in the company when it goes in. You have to have payaway credits, like paid, built up over the years. And there's restrictions there around the length of time that you've been in the company if you have started already. Um, doesn't suit everyone, but it can. There's situations. So general advice around rental property, if any of rental property, is buy it in your own name. Okay. So a lot of the issue around that is for either CGT or succession to children and things like that, of passing on in time. So the whole idea that if you have it in a company, are you going to be taxed twice? Okay, so you might pay CGT selling in the company and then CGT getting it out. Okay, that mightn't necessarily apply. Okay, depending on what reliefs are available to you, but the general rules around it are it's a 25% tax rate as well. So like I spoke there at the beginning, it's 12.5% corporation tax for trades. But if you're looking at investment or rental income, so it's passive income, it's called, that's 25%. Okay, so it's 25%, which you might think doesn't sound too bad relative to potential 52% if you have other income and you're the higher rate tax. There's also a closed company surcharge based on that. So basic closed company surcharge is where there's 5 or few members in it. That includes family members. So even if you think, well, there's 6 of us in the family, we'll all go into it, revenue will count that as one. So they'll group together, yourself, your spouse, your kids, grandparents, siblings, all be grouped as one. So it's, you won't, it's before people are thinking, oh, like there's one way, we'll beat that system. So that won't help. And with closed company surcharge, it's like it brings up the effective rate of 40%. So basically what it means is that you've made profits on rental, you haven't distributed the profits. We'll give you 18 months to do it. And if you don't, we'll hit you with a surcharge. Like just 2 angles to that now. One is that it's still 40%, which is less than your 52%. Okay. And also the money you can keep the money in company, especially if you're thinking of reinvesting the company or doing up buildings, the money's in the company, you can do it again. And the other side of that is there are ways around structures, depending if you have other businesses, that it might work. Okay, where you can do a holding company option to either reduce the surcharge or delay it, or get funds across as well. Okay, so that would involve paying dividends from the rental company to the holding company. Okay, again, it's not just to avoid the surcharge. You have to think about what your plan's doing with the money, medium to long term as well. Just in terms of tax efficient structures, just touch on briefly, is like, in general, I would say separate your business and your personal assets. Okay, so an obvious one there is a company, don't have personal stuff going through it. Okay, even if you have a sole trade or a partnership, have a separate bank account, keep your personal stuff separate. Protect wealth and your limit legal liability. So that might depend on the industry you're in as well. So in terms of like, do you want your trade inside a company and keep it separate? And also if you have property from that company, should be separate to your trade company. So if you have a building, it's owned by the company, you're trading through it, but should that building be in another company, belong to yourself and separate from the trading company, just from a legal liability point of view? That's definitely worth thinking about. And tax planning down the line, and retirement planning and succession planning. Like that's what I'm talking about incorporating strategic entities. Two common ones are based around family partnerships, and then like what you see a lot of data is farm partnerships. So basically, in terms of family partnerships, you get the asset in as today. The kids are brought in, you just do a structure around where you still have control, but that it's in the children's names. And as the assets grow in time, they won't be taxed on those. They've already got at today's value. Okay. And another one is around trusts. So trust can be complex, but then in terms of tax bills can be very effective in terms of long-term tax planning, especially if you're worried about tax bills down the line, but also in terms of who's getting what and who's running what. So trusts and family partnerships outside your limited companies. But again, I would say like talk to a tax professional just to come up with planning. It won't suit everyone. Just 2 points there just to finish up. I suppose why it matters. I suppose everyone's probably trying to get more cash flow, keep cash in their pocket into their business. One place that always goes for everyone is out the door paying tax. Okay. And there's nothing worse than overpaying tax when you shouldn't be paying it in the first place. That there's schemes there you're not aware of, or you're not maximizing things. And the most simplest one is around maximizing tax credits and tax bans. The second one then is just to improve long-term profit retention. So the money isn't going after revenue, it's staying in your account and you can use it to grow the business. And then just about doing things right. So in terms of what we've mentioned there, avoiding penalties. Okay, so you get your compliance done right. Okay, and your tax planning should tie in with your own goals. Then, like, are you thinking of retiring soon? Are you thinking of passing the family members in time? So you got to think about the long-term planning as well. So just to conclude, I'd say is that like corporation tax really planning, it's about maximizing profit but keeping cash flow in the business. Okay, doing things legally but doing them efficiently as well. Okay, and have your own financial goals. And what can you do there? Using the exemptions, deductions, and the credits that are there. Be aware of everything that's there, and can you maximize it? And I would say, like, even just get a consultation to see, could you avail of any of these, and if so, how do you go about doing it? Because there's nothing worse than realizing that just things out there that you're not using and you haven't heard of. Okay. So any questions or any you want any follow up? Just a few contact numbers there. So there's the phone number there. There's info@taxassist.ie, and there's also our website as well, www.taxassist.ie. So just to look, I know there's a few questions there just before we finish up. So under 16's tax, you see PRSI exempt. This should be just replying there to the question. Sorry, was our under 16's tax USC, sorry, PRSI exempt. Yes, if they're under 16's, we have to check because of the PRSI element. But family members would be different as well. So your own children are different as well. But that's a PRSI social welfare question. Could come back to you if you want. Just email me actually just at the info@taxassist.ie there, Derek, if you want more details. Are sole traders entitled to the small benefit exemption? So the actual owner isn't. So sole trader, if you own the business, you can't pay yourself it. But if your spouse isn't employed, so if they're on the payroll is the general thing. If you're on a payroll and paying, submitting monthly payroll or weekly payroll to revenue, if you're on that list, you're entitled to it. If you're on that list for like €50 for 1 week, you technically at the moment you are entitled to it. I wouldn't be pushing that now, but I'm just saying in general, that's the definition is if you're an employee, you're on the payroll. Okay. Is required contracts, etc., differ for a spouse if it is a company director? It would be, because at the end you could just minute that as well. Because if you think about it, no company directors tend to, like in terms of small companies, no company directors would tend to have contracts in it because it's your own business. And if the spouse is a director as well, I would just I'd minute it there, like you're doing minutes for your annual accounts anyway. But you could just minute, even to get it up to date, confirming that they're entitled they're entitled to a contract of employment, and that they're they're not waiving their rights or anything like that, and maybe confirm the salary and just leave it like that. But I wouldn't be worried about a contract of employment for a spouse in terms of the wages system. Okay. In general terms, you might say contracts of employment should be there for everyone. Okay. Just from a marital point of view. The other one is, if I put my daughter down as a director, do I pay employer's PRSI for her? So the thing there with the employer's PRSI, that's actually a great question. Sorry about the employer's PRSI. That comes up a lot with directors. It depends on the shareholding. Okay, so the general rule and it's a social welfare thing rather than revenue, is 25%. So you'd want to watch that because, first of all, you might say, that's great, I'll give her 25% of the shares and she doesn't pay employer's PRSI, but you're bringing into a whole new thing there about her having a share in the company and in terms of succession and tax down the line as well. So I would say get advice on that, definitely. Okay. So just with the Sure scheme, a handful of successful claimants since the scheme was set up years ago, no support from. Yeah, and yeah, I'm just saying, someone's just mentioned there just about the Sure scheme, very little happening with it, very little help from revenue. And there's just some mentioning there that the company's the window of the 2 years is nearly up. In that case, I would get some sort of application in or something through your accountant, through my inquiries, or just to get into the system and get on the record, because at least if they acknowledge receiving it, and you might have a hope of that they'll say, well, the application was received, or we'll welcome it. Whether you get it or not then is another question, but I would say try and get something get you into so that you're not ruling yourself out of the scheme. Okay. I would know people who have got the money in terms of the Sure scheme and all that, but I know what you're saying. There's a lot of revenue schemes like that. Just two more questions there. Someone said about recording be available. Yes, there will be a recording be available and it will be sent out to you. So there's a question there saying, what should you do when you have more cash in the business than is required? I think that's definitely worth talking to someone about, because that, like, you might think that would be smart there, but that depends on your age, your plans for the business down the line, in terms of, are you going to reinvest in assets in the business, who's getting the business after you, where you're at, pensions, cash, but that's a brilliant problem to have. So think you definitely get advice on that. And there's no one answer. I'm not trying to be smart now, but there's no one answer for that. But it's definitely worth looking at. Okay. And can we get a copy of the recording? Yes. Perfect. So perfect. I think that's everyone. There's a few questions repeated there just around recordings and everything. So just to finish up, I'd say, look, thanks, just gone about 2 minutes over time there. So I would say there, I hope it's of some benefit today. I hope I didn't waste your lunchtime for you now. It's 1:30. And I would say just reach out to us there. If you have any questions on tax and accounts in general, reach out to us through the number on the slide. You'll be on your email anyway. And in terms of the email address as well. And if there's anything particular to the slide, by all means, contact us whenever you can. The recording will go out to you, and if you have any questions, sure, we'll talk to you offline anyway. So thanks very much.